I can't believe I fell on my face yesterday. Walking into my hotel room, tripped over my luggage, face first, right into the carpet. Rug burn. Real talk. If you guys think the Iran war has nothing to do with the price of your next property here in Southern California, you are absolutely cooked. Stick with me for the next 12 minutes because what is happening right now in these markets could literally define whether you build wealth or get priced out permanently. I'm Derek, 22 years in this industry. I've done new home construction, I've done resale, I've owned my own property preservation business. I've seen it all, and I want to give it to you with none of the fluff. All right, I'm going to give it to you for Orange County, San Diego, and the Inland Empire. Let's get into it. Before we talk square footage and price per square foot, we need to talk about what's going on in the world because the global economy is literally inside every mortgage payment being quoted right now. Back late in February of this year, the US and Israel launched coordinated strikes on Iran, and what happened next was something economists had been warning about for years. Iran closed the Strait of Hormuz. Here's why that matters to you. Roughly 20 to 27% of the world's seaborne oil trade moves through that strait every single day. And when it's closed, the International Energy Agency called it, and I'm not exaggerating here, this is the largest oil supply disruption in the history of the global oil market ever. Bigger than 1973 and bigger than 1979. Brent crude went from about $60 a barrel in January to surging 50% higher mid-April. The World Bank is now projecting energy prices to be up 24% for 2026. 24%, and that ripple hits everything. That's going to hit gas at the pump. It's going to hit construction costs. It's going to hit logistics, food, and yes, it's going to also hit your mortgage rate. A ceasefire was announced on April 8th, but here's the no-cap truth. The ship traffic going through the strait is still well below pre-war levels, and the dual blockade is still in play. So this is not resolved. The market is still watching every single headline. In February, the 30-year fixed rate dropped below 6%. And that was for the first time since 2022. Buyers were getting excited. The spring buying season was just starting to get loaded. And then the Iran war happened. And let me hit you with the rate reality right now because this is the number that controls everything. By late March, rates had jumped to 6.37%. And as of today, which is May 5th, 2026, we're sitting at 6.48%. And that's on a 30-year fix. That's up from where we thought we'd be right now. The Federal Reserve held their rates steady at the April meeting, but here's what the media isn't really telling you is that it was an 8-4 vote, and that was the most divided vote since 1992. 3 of the governors wanted to remove the wording that talked about rate cuts, and 1 governor wanted to cut. So the Fed is fractured. And the inflation data isn't helping. March CPI came in at 3.3%. That's the highest since April of 2024. And energy alone was up nearly 11% year over year. Gasoline up 21%. Bottom line for rates, traders are now pricing in a 0 Fed rate cut for the rest of 2026. And if you get a May CPI print above 4%, which one analyst is kind of warning, the next isn't going to be about cuts, it's going to be about hikes. Now, does that mean you wait? I'm going to answer that in the general breakdown because that answer is different depending on which market we're talking about. Orange County, let me tell you what's happening here. At the end of 2025, OC medium home values were sitting around the mid 800s to low 900s range. And though the first 60 days of spring 2026. So what we are seeing is at a stable, compressed market. Prices saw a modest year-over-year uptick of about 2.1% in early reporting. Sales volume is up about 2.4% year-over-year, but affordability 9%, meaning only of Orange County households can actually afford the median home at current prices and rates. That right there is a choke point, people. What does that mean on the ground floor? It means that prices and entry-level product, basically anything that's sub 800K is still moving and it's still getting attention, and buyers who can qualify are jumping on it now because they know that the rates are basically just not going to drop. Now on the luxury end, $1.5 million and up. This is still competitive because the high net worth buyers are typically less rate sensitive. A lot of them are just, paying cash, putting at least 40% down. So that segment right there hasn't even blinked. Where's Orange County feeling the pressure? Well, that's going to be in the mid-market. So that's going to be your $900K to $1.3 million range. Those are the buyers that are most impacted by the rate move from that 5.87% all the way back up to the 6.48%. I mean, that right? Every month we're talking $400 to $500 difference a month in payment. And those buyers are reevaluating. And for new home builders, well, I'm sitting in a new home builder office right now, and I can tell you that incentives are back, rate downs, closing cost credits, design upgrades. Builders are going to do what they need to do to keep their velocity of sales. So smart buyers are taking full advantage of that right now. What about San Diego? Well, this market has some of the strongest fundamentals in the entire country. You've got a military economy, you've got biotech, you've got tourism, limited land, and yet San Diego has one of the sharper corrections in 2025 with values down about 2.6% year over year by year end. But here's the thing, Zillow and the most popular forecasters are calling for San Diego to bounce 1.1 to 1.6% this year. And that forecast was made before the Iran war had rattled all these rate expectations. So we're going to see if that holds. Right now, San Diego's average home value is right around $918,000 and affordability sits around 15%. So inventory is still tight, which is the main reason this market hasn't corrected harder. What's performing? Coastal, La Jolla, Del Mar, Carlsbad, still strong. Military corridor communities around Camp Pendleton and Miramar, consistent demand on that kind of stuff. East County and South County is where I'm kind of watching softening because the buyers are rate sensitive and they're competing with, at that point, they're competing with Inland Empire pricing. The area getting the most downward pressure would be Chula Vista, National City area. More of those first-time buyer-dependent, more FHA, VA dependent, and those loan amounts are tighter when rates are at 6.48%. But even though the inventory is still very limited, so we're not seeing a whole bunch of dramatic price drops down there, we're seeing days on market stretch from 31 days to maybe 35 days versus the 20-day market that we saw on last fall. The San Diego seller sentiment is cautiously optimistic. They know they hold the cards. There's just simply really not enough supply, but they're starting to price more realistic. So the days of pricing at 10% above what the market should be, that's super sussy right now. I mean, it's not that it doesn't exist. You have to have the right home and the right location. So I've been in this one because the Inland Empire, Riverside, San Bernardino counties, these actually might be the most fascinating market in Southern California right now, and I really mean that. The average home is around $574 to $579. Price per square foot is $371 versus $687 per square foot in Orange County. I mean, that gap right there is that is what happens. You know, when a person can't afford Orange County, or if they can't afford to buy in San Diego, those people don't just disappear. They move east. They move east towards with remote work still alive in a lot of those industries, the Inland Empire has been a strong alternative for them. Year-end 2025 showed that the IE was down about 2.5% year over year. Similar to San Diego, but the forecast for 2026 is actually stronger for the IE than the coastal markets. So one forecast has it at a 2.3% gain. Rental demand is surging, strongest rent growth in all of Southern California at 3.2%. Where specifically is booming, that would be your Temecula, Murrieta corridor. Those places are always on fire. Wine country vibes. You got newer construction, still relatively affordable for the San Diego and the Orange County crowd. But Menifee is one of the fastest growing cities in Southern California. Just got named Southern California's boomtown, and Winchester really not too far behind it. Just kind of borders up right on Menifee. Rancho Cucamonga, Ontario have benefited from massive logistics and warehouse employment. Amazon, FedEx, those job centers are generating real buyer demand out there. But where's the downward pressure? We're talking San Bernardino City proper, the older areas of Riverside where there just isn't a whole lot of newer infrastructure. Also, anything over 650K in the IE is starting to see longer market times because that buyer is now comparing to base coastal pricing and questioning the value proposition. Buyer sentiment in the IE right now, well, this is where the market where I'm seeing the most activity from first-time buyers, people who get pre-approved 6 months ago, who were expecting rates to drop and are now saying, hey, okay, rates are not going to drop. They're not down, so I better lock in pricing before prices go back up. And that urgency is real. So let me give you the honest macro picture for what the next 12 months looks like. If the Strait of Hormuz situation gradually resolves, which the World Bank's baseline assumption is, we could see energy prices stabilize by late 2026. If core inflation drops back towards 2.5 to 3%, the Fed gets its window to cut rates. Even 125 basis point cut could bring the 30-year mortgage rate below 6%, and that would light this market up. But if the blockade drags into summer and oil prices stay elevated, and if that May CPI prints hotter than expected, then the Fed is going to be backed into a corner. So rate hikes at that point in time become a real conversation. And that scenario, which nobody really wants to say out loud, would put serious pricing pressure on the IE price band and mid-market Orange County. If you want the truth about all three markets, I'm just going to tell you this. Southern California doesn't crash. It corrects, it holds. The land here is scarce, population is growing. People have the lock-in effect, mortgage rate, so inventory is still going to be pretty scarce, and supply is not going to be coming to save buyers anytime soon. What is softening is buyer urgency and confidence, but not because people don't want to buy, but because, when you have a 6.48 interest rate, $800,000 home, that's $4,800 a month, not including taxes and insurance, and that, if you add that on, that's some serious income that's going to be needed. Right now, with all of that economic uncertainty, with the job market softening, geopolitical fear, that makes people hesitate. So the next 60 days, I think we're going to be in a holding pattern with a lean towards modest appreciation in the IE, flat to slight compression in Orange County, and San Diego's just kind of holding steady on the strength of limited. Going to be really winning big. Nobody's going to be bleeding out. It's a market that rewards preparation and penalizes hesitation. So here's what I want you to take away from this. If you're a buyer right now, especially a first-time buyer, stop waiting for 2026 to hand you a perfect market. I mean, the perfect conditions are not going to be 2026, right? But what you do have is you've got a bunch of motivated sellers out there, and you've got a bunch of builders that are offering a ton of incentives, and you might have that small window right now before prices actually start to go up in the second half of the year. And if you're a seller, you want to make sure that you price accurately. The buyers who are out there are serious. They're pre-approved. They're savvy. They're going to want to, they know their value. They're not going to be that 2021 FOMO. They're going to want some kind of deal. They're doing the math out there. So make sure that you're priced right. Make sure that you're presenting well, and you will move your home. And if you're a real estate professional watching this, your clients need this context. The Iran war, the energy pricing, the Fed divide, these are not all abstract headlines. They are the direct explanation for why they're seeing their rate quotes come out to be what it is today. Give them the explanation. Be the expert in the room. That's your Southern California update for May 2026. I'm Derek Cruz, 22 years in new home construction and the real estate industry. And guys, if this hit different, drop intel in the comments below so I can continue to bring you weekly market content that actually respects your intelligence. I will see you on the next video.